Well, hello, everybody. We are coming in with a volatility special. This is the equity market call for August, although we might have another shorter one later this month. I'm Tory, the CEO and co-founder here at Equi, and with me I have Itay, our chief investment officer and my illustrious co-founder. Itay, what have you been seeing in markets? I know we gave a warning in our last call that this melt up might not be sustainable, and it seems like that prediction was quite prescient.
Seems that way, but I would say with a big caveat, right? Anything can and will happen in financial markets and possibly even eclipsing that high later in the year. But let's dig into it and understand why and how these things kind of happen and what plays out. I think we're in a very interesting point in the cycle, really kind of late cycle. And we know that because the Fed is getting ready to cut interest rates based on both their indications of what they're going to do as well as kind of market predictions. And that's typically the end of a cycle, the end of kind of a high interest rate cycle. So we can analyze a little bit of that and what's been going on in financial markets. I think we're in for a very interesting time, as always. We've been in a period of calm for the last year or so, and that seems to have come to an abrupt end in the last week.
Yep. So did you prepare some content for us today?
Absolutely. And I'm going to share it right now.
Great. Yeah, no, it was pretty wild to see the VIX go from, what was it, from 12 to something like 62 in just a matter of days.
Yeah, take that with a grain of salt, because what really happened there was that happened for a few minutes versus what you typically see that kind of lasts for a few days. I think that there was just no liquidity trading at that time, and as a result, that's kind of what we saw. But the VIX future is only traded to about 30 or so, 30 and change, nothing close to the 60 that we saw in VIX spot. So I think that's really a function of illiquidity, because if you go 1 hour into the open, the VIX did trade about in the 40s and 30s. So I take that read with kind of a grain of salt. In a way, it's kind of the biggest financial crises we see: Lehman, COVID, and Bank of Japan raising rates by 0.25%, right?
Right.
So in a way, I think it's a warning shot, but I don't necessarily see that read as kind of a real VIX read.
Yeah. And for those unfamiliar, the VIX, again, is just a measure of volatility or fear that we're seeing in the market. And for the longest time, despite all the wild things going on in the world, ranging from war to rate hikes to lots of warning signs throughout the economy, the VIX has been very, very low, which is quite unusual. So again, sounds like it was a wake-up call. What do you got lined up for us?
Okay, so August 8th, 2024. It really all starts in the land of the rising sun. We've heard all these things about the Bank of Japan and what's been going on. We've covered this extensively, actually, over the last few years, as Japan is kind of the late stage of what we call the Keynesian economic endgame, in a way. And really, what they're suffering from is a significant amount of debt, which really makes the US debt look very manageable in comparison. And at the same time, they've had very low interest rates for a very long period of time, which enabled that to happen. And they've had quantitative easing programs literally since forever. Long before Western central banks were doing it, Japan was the first to really be doing it. And really, the Bank of Japan is the first bank in history that has more than 50% or about to have more than 50% of the public debt securities on their balance sheet. So they've done so much QE that they are effectively the Japanese government bond market. And it's a real unprecedented situation because the impact of their policy is just massive. To get an idea of what we're talking about into 2024, Japan is tingling with the 450% debt to GDP ratio, right? We're talking about the US ratios. Just keep that in mind of why even a small increase in interest rates is so significant for Japan.
Yeah, these are wild. And I mean, when you compare, where does the US stand today?
Well, total debt is a little different than government debt. Total debt in the United States is higher, but government debt to GDP is approaching 130% levels, things like that. So you could argue that government debt in Japan is obviously lower, but total debt in the United States as well is, in the 200s, very different than where Japan is.
Yeah, yeah. Well, it's staggering to see, and it is funny because this is something that I remember, although a few years ago, actually, it might have been as far as 2021, maybe even 2020. You were talking about, one of the things you're keeping your eye on is the carry trade at Japan, and you're like, I wouldn't be surprised if down the road, contagion perhaps starts there, and there's a risk to the entire global financial system sitting there in plain sight. But again,
Right.
it still could be early. It might not actually turn into a full-blown crisis. What else can you tell us about what's going on?
So, in order for it to become a crisis, we talked about it in 2021, but in 2021, inflation in Japan, as measured here, was actually below zero. So we still had deflation. Japan has had an issue that they've had no growth or stagnant growth for a really, really long time. And then after COVID, just like everywhere else, even Japan got inflation. Their CPI actually got as high as 4%. But what's interesting now is that inflation in Japan is stabilizing at 2.8 or just under 3%. So for the first time in a really long time, Japan has real inflation. Remember, Japan, though, imports all the raw materials that they have. So they need oil, they need rubber, they need a lot of things to make all the stuff that they make in their economy. So they don't want a currency that's too weak because that makes it very difficult for their consumers. They're not used to inflation. And it makes it difficult for Japan. They need to spend FX reserve in a hard currency in order to kind of take care of that problem. So really, they're stuck between a rock and a hard place because if they have real inflation and the central bank keeps rates at zero, the yen just, slowly goes into oblivion. But if they raise interest rates, they have too much debt. So the result could be extremely deflationary and potentially devastating to the economy and really to the world. So that's really what the Keynesian endgame is that, Austrian School of Economics predicted that at some point you get to this place where you can't lower rates anymore because you get inflation. You have too much debt. What do? You're kind of stuck. So let's talk about this carry trade. For a very long time, Japan has had 0% interest on the yen. So what do you do as a savvy global investor? You borrow money in yens because you're paying nothing for it, and then you can invest it anywhere in the world. You can invest it in American bonds. You can invest it in Bitcoin. You can invest it in risk assets like the NASDAQ. And you could do all those type of things because at some point, Japan was even a negative interest rate. So you're getting paid to borrow in Japan and invest somewhere else. And because you're expecting the yen to weaken as a result of that, not only you're making the 4 or 5% rate on US treasuries, for example, you're also making the amount of the yen is depreciating. If the yen's depreciating 10% a year, plus you're making 5% on US government bonds, you've now made 15% a year, right? It's a no-brainer.
Yep. No brainer for a lot of people, to the amount of, if I'm reading that last line correctly, $4 trillion.
$4 trillion.
Potentially.
That's right. Potentially. So what the yen trade really is it's not really about Japan and Japan's economy on its own. It's a global proxy of leverage. This is how a lot of funds and a lot of players in the world just leverage their bets. They use the yen as a way to place other bets all over the world, which is why in those few minutes on Monday, what you saw is Ethereum going down 30% in a few minutes. You saw VIX spiking to 60 for like 5 seconds. And you saw, even though I don't know, I'll read how real that read is, but you saw equities dropping substantially, and literally every single asset class in the world was trading in unison to varying degrees of volatility, most likely because they're all fueled by that leverage from the yen. This is a chart of the S&P 500 versus the dollar yen, and you can see that this period of yen strength, because it's upside down USD JPY, really associated with the sell-off in the S&P 500, extremely correlated while that was happening.
What time period are we looking at here?
This is about a month. So maybe a little bit longer than I'm sorry. This is actually year to date. So that's a year. So that's kind of the April correction. And then this is the top here in July.
Okay.
So
got it.
Very quick kind of unwound of this trade, and the question is, of course, what's next? Um, Again, my suspicion is the carry trade is just a proxy. I don't think that there's just sure, the Bank of Japan raised rates by 25 basis points on Thursday. No one expected that. And that, of course, caused some deleveraging in the yen, and then everything around the board kind of started selling off. But we have to remember that on Friday, we also had a very bad jobs number. And we've been seeing macro deteriorate for quite some time. And the SOM rule actually triggered on Friday. So what is the SOM rule and why is it important? Well, the SOM rule is associated with the idea that if unemployment rises by 0.5% or more within a relatively short period of time, you have typically are entering a recession or have already entered a recession. Here you're seeing the unemployment rate, U3 unemployment rate, going back to 1950 with the SOM rule. So this is the unemployment rate. So you can see that every period that the SOM rule triggered going up over 0.5% actually resulted in a recession. And the red areas are a recession. And you can see that each one of these spikes actually was associated with a US recession. What was interesting here is that it never stopped at 0.5%, and it kept accelerating to a much higher unemployment level. Some of them relatively small, like this 1990 recession. Some of them very big, like this 2008 recession. And even COVID was triggered the SOM rule. So again, very interesting dynamic. And clearly it didn't help that the SOM rule was triggered on the Friday after the Bank of Japan raised interest rates.
Yeah. And so talk to me a little bit about why it's such a strong predictor, and why does, an increase of 0.5%, which, in the grand scheme of things seems like not a huge change in labor participation. Why is it so predictive?
Yeah, and here you can see all the instances as well, coming from which unemployment rate, when the recession actually started. It's been one of the most reliable indicators for a recession, historically speaking. And I think the reason is the economy moves really slowly on a grand scheme until it moves fast. And decisions made in boardrooms and all this type of, decisions of hiring and firing, etc., they're relatively slow. So when you rise about 0.5% in that short of a period of time, it just means the economy is stalled enough that the stalling effect is going to continue. It's just, think of it as this giant ship that kind of like moves to the right. And once it's doing that, it's just so hard to stop because, you can't just hit the brakes. The turn has already started and the momentum in that direction is already going. So it's incredibly difficult to stop it once that's happening. It's kind of like the long and variable lags of monetary policy we all talked about. The Fed makes a decision, something happens, could take a year, could take longer until that decision takes effect. The SOM rule is very similar, right? Once the economy moves, it moves. And, it's very difficult to stop.
Yeah, that makes sense. Yeah, it seems like something like that. I mean, a lot of damage has to have already been, spread throughout the economy before you start to see, widespread changes in employment. So presumably, this is kind of like it's a warning sign. It's like the change has begun, but it's very early.
Right. And sometimes the recession came in later. Sometimes we're already in a recession. Actually, the last few instances when the SOM rule triggered, in hindsight, we know we already were in a recession. So time will tell whether that's the case today. But we do have warning signs. We've had warning signs for a while. Here you're seeing the JOLTS data, which is job opening data. So how many jobs are open, available in the economy versus the actual unemployment rate. And we talked about this. This goes back to 2000, where the white line is the job opening and the orange line is the unemployment rate. And you can see that, the number of open jobs has deteriorated massively from 2021, peaking at over 12 million, actually decreased quite significantly. And only now you're starting to see this pickup in actual unemployment rate. So there was a significant tell to tell us that this is happening in real time. And we've seen that in prior recessions too, where job openings are kind of dropping ahead of the spike in the unemployment rate. We've seen that time and time again, right? In 07, 08, we've seen that as well. So again, we're late cycle. We've been talking about that for a while. This cycle has lasted longer than expected. That doesn't change the fact that we're pretty late cycle.
Well, help me understand though, when I look at this chart, it almost looks like where we are right now is actually just a return to trend. Obviously with COVID being a huge pattern interrupt there, leading to a bust and then a giant boom in job openings. But if you look back to prior to COVID, it almost seems like we're back on that trend line.
Right. The biggest, and by the way, that's kind of the soft landing camp is exactly what you're saying. The thing is, again, though, once the stall happens, can you really stop the snowball from continuing? Can you stop the avalanche? That's the $1 trillion question. Because again, the economy, once it reaches the stall speed, that's really the big problem. And that's why historically soft landings have been incredibly difficult to accomplish, is because sure, the Fed is able to slam the brakes and does stall the economy. Slamming the brakes just enough to avoid the economy actually crashing has been a totally different story, which is why the Fed has rarely been able to achieve soft landings.
But could it just be that these job openings, we're getting it back to, pre-COVID amounts of job openings, which, could be a regular amount. And it's just, there was the huge surge due to the stimulus, like unprecedented levels of stimulus. But now coming out of that sugar high, so to speak, job openings are returning to a more normalized level. Is that what you're saying? That's the narrative of the soft landing camp? Like, but what evidence would we look at to debunk that?
You would, so in order for that to play out, this will start continuing, this will actually trough around here and then start moving up in a mild fashion, right? Like in this kind of way, versus crashing down and continuing like it did during recessionary periods.
Okay. So I guess we'll see. So your answer is time will tell.
Time will tell. It's very hard to say in advance. My opinion is based on history, it's been very difficult to accomplish, which gives it a much higher probability that it just won't happen.
Got it.
So let's talk about the Fed response to what we're seeing. What we're seeing in the markets and what we're seeing in the job numbers, particularly after what happened on Friday, which was also a very bad day in the market, there is now a significant amount of rate cuts priced into the market, which is why I'm fairly confident in saying that we are very late cycle. I believe that the September meeting will see the first rate cut. Now, what's really interesting is that there is now a greater than 50% chance that there are 2 cuts already priced for September. After the jobs number came out on Friday, the market decided that actually the Fed's going to cut 50 bips, not 25, which at the end of the year in December, we have 4 cuts priced in already. So that's a very aggressive beginning to the cut cycle. That means that the Fed fund rate will be a full 1% lower in December than it is today. And then another 2 cuts in January. So very, very aggressive cuts are priced in, which means that the market is, or at least the bond market is buying the narrative that we are entering a recession and the Fed is going to have to cut rates very quickly. Ironically, if the Fed cuts rates very quickly, that can cause an even greater unwinding of the carry trade. Because one of the things that the carry trade is based on is the interest rate differentials between the United States and Japan. If Japan is still seeing inflation and the Bank of Japan needs to raise interest rates even a little bit, despite the huge amount of debt, and the Fed cuts very quickly, that actually is bullish for the yen and bearish for the dollar, right? So in a weird way, if the Fed cuts too quickly, that's going to hurt the yen carry trade as well. So it's a very interesting kind of balancing act. And when you're dealing with global leverage on that massive $4 trillion just in the carry trade, something to consider. And of course, one of the big questions that I get is, well, but if the Fed cuts rates very quickly, that's going to be bullish. That's going to be good for the economy. And the answer is that's really not the case historically. As much as people like to think that rate cuts are good for the economy, remember that everything works with varying lags. And monetary policy definitely works with a lag. Even if the Fed cuts rates, you may not see the benefit of that for another year or two. I pulled this chart here starting in 1999, going all the way to 2028. And we can see all the cut cycles that have happened. The dot-com one was a pretty aggressive cut cycle. We went here from over 6%, the Fed fund rate, all the way down to 1.25% in about 2 years. What's interesting is the S&P 500 dropped 50% during the time the Fed was cutting rates, and it didn't trough out until the Fed was actually done lowering rates, as you can see right there. 08, 09, very similar. The Fed cuts rates for the first time around late 07, cuts rates all the way to zero. And again, market doesn't bottom until the Fed is done cutting. COVID, very similar. We have the COVID crash going down into March 2020, that we go back to zero, market bottom. We have the big ripper of 2021. Now we know the cycle is kind of over. Fed is going to cut rates in September. The big question is how quickly. History tells us that very fast and aggressive rate cut cycles are not bullish for the market. So I'm going to phrase that. So, that's where we're at. But that doesn't mean that we're not going to get more volatility here. It's even possible that into the rate cuts, the market will even make a new high for the year. All these are completely unexpected as volatility has picked up. But we are, very late cycle where the risks have increased significantly. Now, the caveat to what I've shown you right now is that, if we go through a couple of different things that can happen. First one, obviously, is that soft landing that you have mentioned, where inflation moderates, the Fed cuts rates, but not aggressively like this, right? We go very gradual rate cuts. We do get that soft landing, market stabilize, the economy kind of stays fine. That camp has been going on for about a year, but now there's more and more evidence that may not be the case, as the market's kind of pricing things in that may not be the case. But there's also the stagflationary scenario, which I think is very, very important in next week CPI. We've had CPI events becoming more important, less important. I think next week's CPI is very, very important. Currently, the market is expecting roughly a 3% CPI read. You can see that core has remained very elevated. CPI has remained around the 3% rate. It's not really coming down the way the Fed wants it to come down. It's pretty sticky, something we've warned about for a while. As you can see, core has not really changed dramatically. If we get an upside surprise in CPI next week, I think that sets up as a major risk event for the market, as now the markets are pricing in a potential recession and big rate cuts. What if we get a hot CPI and that doesn't come true? I think that's a major risk event for both bonds and equities setting up next week, and will give us a lot of indication, because, we talked the soft landing, we talked recession, but we also have the 1970s scenario where we could also get stagflation. What if we get another wave of inflation while we're going through a recession? Then these precedents don't really apply, because in all these recessions, the Fed was able to lower rates because there was no inflation.
Right.
So that's where we're at.
So let's unpack that a little bit, these conclusions, and tie it back to what does it mean for me, the proverbial investor, right? So, okay, I've got a couple different things we're watching. Let's see what inflation is doing. Does it continue dropping, or does it come back? Another element we have to watch is, when do the cuts start, as well as how rapidly do they, hit in? And then the other thing we need to think about is, like, amidst all of this, if you're the average investor and you're sitting in predominantly stocks and bonds, what should you be thinking? How can you be preparing yourselves, for these various scenarios? Because it still seems like there's a wide variety of scenarios that can play out.
The best advice I can give any investor is diversification wins at the end. All these things may or may not happen, but we cannot rely on the same return drivers that we've had for the last 20 or 30 years. And I think that's really the key here. If you look at the 1970s, for example, during a period of rising rates and a lot of economic volatility, the 60-40 portfolio didn't perform as well, and passive strategies didn't perform as well. So adding active strategies to your portfolio, adding alternatives to your portfolio, and adding non-correlated assets to your portfolio, that's the ultimate safeguard for the long run, especially, if valuations are high, if we have a lot of volatility in interest rates. I think relying on just equities and bonds, and particularly equities, as people have relied on them more and more as the sole drivers of your portfolio, are going to be a more risky proposition in into the 2020s and possibly into the 2030s as they have historically. And I'm not even talking about, valuations like the Shiller P and other things like that. Ultimately, it's about proper diversification, and not just, asset class, but strategy diversification.
Well, so what if you're sitting on a lot of risk assets, right? Because risk assets have done so well, right? So maybe you've got a good amount of crypto or, FANG stocks. When you're sitting on large amounts of risk assets, like, is this a good time to be thinking about rebalancing? And if so, like, what are a few things that you're looking at right now that you think are, good places for a rebalancing portfolio to place some cash?
So again, without getting into specific advice that I don't want to give because everyone's situation is vastly different, um, I do think that, given all these variety of scenarios and potential volatility that we're seeing, I think that it makes sense that the end of the cycle, as we get towards that first cut, if it does look like 2000 or 2008 or 2007, I would say, or some of these other historical cycles, around that time is a very good time to rebalance historically, because we don't know if you're really going into a soft landing or hard landing or et cetera. It's interesting because we thought last year the Fed were already going to cut. It stayed higher for longer, much longer, because the cycle just lasted a longer period of time. But when you actually see the first cut, when it actually comes, historically, then that kind of cutting cycle starts. That should be a good time for reducing risk, rebalancing, and increasing exposure to uncorrelated assets.
All right, understood. Last couple questions. What do you think about gold amidst all of this? I know you're talking about a diversified portfolio. Do you think that has a place in it?
Definitely. Gold, even though it's had a massive run already, caveat is gold can trade correlated and can not trade correlated. In '08, for example, gold did drop 30% with the global margin call. We've seen gold actually drop as well with the carry trade situation that happened. So even though gold is a good diversifier, I wouldn't necessarily assume that it's a, riskless asset, or I even would say that don't necessarily expect it to rise when, risk assets are crashing. It can, but it doesn't necessarily mean that it would. US government bonds, similarly, it really depends on the type of event we're going to have. If we go into a more classic recession where inflation actually dies down, long-term government bonds like TLT are going to do really well. If we get a stagflationary recession like 1973-74, TLT is not going to do very well, and actually very, very few things would. So again, that's one of the reasons we're watching for inflation. But also, what made 1973 so rough for both equities and bonds is the geopolitical risk and some of the oil shocks, supply shocks that we're seeing similarities of. We're one oil shock away from something like that happening. If there was, let's say, a regional war in the Middle East. And if that's of interest, we're about to come out with a pretty extensive piece comparing the 1970s period to today. There's a lot of similarities in the way markets are trading, how the economy is running. And we're gonna post that relatively soon, and that's gonna be a great piece of content.
Awesome. I'm looking forward to that. This has been a great download and a great volatility special. I'm excited to see what the markets hold over the next few weeks. And no matter how you look at it, it's exciting times. So stay diversified. That's always been our philosophy. And, it sounds like your advice is the more uncorrelated return streams, the better. I know that's our philosophy. We're wishing everybody luck going into this new regime that it seems like we might be in the middle of a transition towards. Let's see how it goes.
Let's see how it goes. And again, take every day as it is. The markets with, even though they're down 10%, there's nothing special about that yet. That's just the garden variety correction. And, our expectation is that we will probably bottom in the next few weeks, if haven't already, and potentially the markets will recover into the Fed rate cut. Could be a little more volatility, could go a little bit lower, maybe another 5-10% lower. But there probably will be an attempt to go up into that rate cut. And then I think the we'll see part kind of starts.
Got it. All right. So we'll be keeping our eyes peeled and we'll keep the content coming. That's all we got for you today. Take care and talk to you soon.